If you've ever Googled how to start investing, you've probably come across Warren Buffett's golden rule. Just invest in the S&P 500. Simple and straightforward, and honestly, comforting. Because who doesn't love the idea of setting it and forgetting it? But here's the problem. What do you do when the market's hitting record highs and every headline screams, "The crash is coming"? Now, if you're sitting there wondering, wait, is Buffett still doubling down on the S&P 500 for small investors? Or is there something smarter that I should be doing right now? Well, you're not alone. A lot of people are asking the same thing, and today we're diving into exactly that. In this video, I will show you why Buffett loves the S&P 500 and if that still holds up today. We'll look at the current market reality, and I'll show you some smart alternatives, some you might not even have thought of. In the end, I'll show you a simple strategy that you can start today to build wealth, even if the market takes a nosedive. Let's start with why Warren Buffett is such a fan of the S&P 500. It's not just because it sounds fancy, it's because it works. The S&P 500 is a collection of the top 500 companies in the US, covering roughly 80% of the entire stock market. That means when you invest in it, you're essentially betting on America's economic growth. Over the last century, the S&P 500 has delivered an average annual return of 10%. That's not bad, right? Now, Buffett's main advice for regular folks, people who don't have time to analyze stocks all day long, is to dollar cost average into the S&P 500. What's that, you ask? It's basically a strategy where you invest a fixed amount of money at regular intervals, no matter what the market is doing. Think of it like buying your favorite coffee every week. Sometimes it's on sale, sometimes it's a little pricey, but over time, you even out the cost. Why is this so powerful? Well, let's break it down. Say you invest $500 a month into the S&P 500 for 30 years. Historically, that would have grown into a massive $1.14 million, assuming the average 10% return. And you didn't need to lift a finger or stress about timing the market. That's the magic of compounding, letting your money make more money while you go to sleep. Buffett favors the S&P 500 not only for its returns. He loves it because it's simple. You're not out here trying to pick the next Tesla or timing the next market crash. You're just betting on the long-term growth of the United States economy. And historically, that's been a winning bet. Of course, that simply doesn't mean it's stress-free. Right now, the S&P 500 is sitting at record highs. And you might be thinking, is it really a good idea to invest when the market is this expensive? Well, that's a good question, and let's tackle that next. All right, let's talk about the elephant in the room. The S&P 500 is expensive right now, like really expensive. One way to measure this is through something called the Shiller PE ratio, which looks at stock prices relative to their average earnings over the past 10 years. Historically, the S&P 500's Shiller PE ratio has averaged around 16. Today, it's hovering around 30. That's nearly double. And it's a red flag that investors are paying a premium for stocks. So why does this matter? High valuations often signal that the market is overconfident, and that's when the bubbles form. For context, the Shiller PE ratio was similarly high just before the dot-com crash in 2000 and that financial crisis in 2008. During those downturns, the S&P 500 lost around 50% of its value. Now, don't get me wrong, this doesn't mean the market is guaranteed to crash tomorrow. Predicting that is likely trying to guess when your favorite TV series is going to jump the shark. But it does mean we should be cautious, especially if you're just starting to invest. Here's the dilemma. If you put your money into the S&P 500 now and the market drops, you'll see some painful short-term losses. On the other hand, if you stay out of the market entirely, you risk missing out on potential gains if the market keeps climbing. So, what's the play? The key is to balance optimism with realism. Yeah, the S&P 500 has a solid track record, but you don't have to bet everything on it, especially not at these levels. If the S&P 500 feels like a risky bet at current valuations, diversification is your best friend. Instead of putting all your money into one index, you can spread your investments across different funds, sectors, and even asset classes to lower your risk and increase your growth potential. One great alternative is total stock market index funds, like Vanguard's VTI, which includes thousands of companies across all market sizes, large, medium, and small ones. This gives you broader exposure compared to the S&P 500, which only focuses on those top 500 largest companies. For example, if you invest $500 a month into VTI instead of the S&P 500, you're betting on the entire US economy, not just that top tier, which can offer more balanced returns over time. Beyond the US market, international funds like Vanguard's VXUS can be another valuable addition. These funds give you access to companies across Europe, Asia, and emerging markets, which are often underrepresented in portfolios focused solely on American stocks. While international markets have historically delivered lower returns, around 6% annually compared to the S&P 500's 10%, they can act as a safety net when the US market struggles. A better approach is allocating 20% of your portfolio to VXUS alongside your domestic holdings. This way, if the US market faces a downturn, your international investments can help offset the losses. Another option worth considering is value stocks and dividend-paying companies, which align closely with Warren Buffett's own investment philosophy. Companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble offer steady growth and consistent dividends, making them reliable choices, especially during market volatility. Dividend stocks can also provide a steady income stream. For instance, if you invest $10,000 in a dividend stock with a 4% annual yield, you could earn $400 per year without even touching your principal. Adding a mix of dividend-paying stocks or ETFs, like Vanguard's Dividend Appreciation ETF or VIG, can bring stability and cash to your portfolio. Finally, don't forget about bonds and safe haven assets. Treasury bonds, which are currently yielding 4 to 5%, are a low-risk way to balance out the more volatile parts of your portfolio. If the stock market experiences a sharp decline, bonds tend to hold their value, providing a cushion against losses. Other safe haven options like gold or real estate investment trusts can also play a small but important role. A balanced allocation such as 60% stocks, 30% bonds, 10% alternatives like REITs or gold, that can offer a mix of growth and security, helping you ride out the market turbulence while staying invested. Dollar cost averaging is one of Warren Buffett's go-to strategies, and for good reason. It works. The beauty of DCA is its simplicity and its ability to take emotion out of investing. Instead of trying to time the market, which even the pros struggle with, you invest a fixed amount of money at regular intervals, whether the market is up, down, or even sideways. Over time, this strategy averages out the cost of your investments, allowing you to buy more shares when prices are low and fewer when prices are high. For example, if you invest $500 every month into an S&P 500 ETF, you'll naturally accumulate more shares during market dips, positioning yourself for greater gains when the market recovers. It's kind of like stocking up on your favorite snack when it's on sale. You're spending the same amount of money, but getting more for it. But what about using DCA in today's high market environment? If the S&P 500 is overvalued, does it still make sense to invest consistently? The short answer is yes, but with a bit of a twist. Instead of putting all that money into the S&P 500, consider diversifying your DCA strategy to include your other assets. For example, investing that $500 every month into a mix of assets we discussed earlier. You might allocate $300 to a total stock market ETF like that VTI, maybe $100 to an international ETF like VXUS, and $100 to bonds through a fund like BND. By doing this, you're spreading your investments across different asset classes while still taking advantage of DCA's benefits. Let's say the market experiences a sharp decline, and your investments temporarily lose value. With DCA, that $500 monthly contribution buys you more shares when prices are lower, setting you up for greater gains when that market recovers. For instance, during the 2008 financial crisis, the S&P 500 dropped by over 50%. But investors who stuck with their DCA plans were able to buy shares at deeply discounted prices. By the time the market rebounded, those investments had grown significantly, proving the power of staying consistent during tough times. Now, in today's market, where the S&P 500 is now sitting at record highs, there's a valid concern about whether DCA is still the right move. The answer lies in diversification. Instead of putting all your contributions into one fund, like the S&P 500, splitting them across multiple assets can provide balance. For example, while VTI gives you exposure to the entire US market, VXUS adds international diversification, and BND provides stability with fixed income assets. This mix reduces the risk of overpaying for an overheated market while still positioning you for long-term growth. While lump sum investing historically outperforms DCA in rising markets, it's often harder for small investors to stomach the volatility that comes with it. DCA, on the other hand, helps you stay disciplined and consistent, which is critical for long-term success. Market crashes are enough to make even the most seasoned investor feel uneasy, but Warren Buffett sees them differently. To him, crashes aren't disasters, they're opportunities. His famous mantra, "Be fearful when others are greedy, and greedy when others are fearful," is a reminder that the best time to invest is often when everyone else is panicking. During a crash, strong companies with solid fundamentals often get dragged down with the rest of the market, making them available at bargain prices. For example, during the 2008 financial crisis, Buffett invested $5 billion into Goldman Sachs when the company was struggling. His investment included high-interest preferred stock and warrants to buy common shares at a discount, earning him billions in profit once the market recovered. While most people were selling out of fear, Buffett saw an opportunity to buy quality assets at a steep discount. Crashes are essentially a clearance sale for investors who are prepared. Think about the COVID-19 crash in March 2020, when the S&P 500 dropped by 34% in just over a month. Investors who bought into the market during that time saw massive gains as the market rebounded to new highs in less than a year. But many panicked, sold their holdings, and missed out on the recovery. The key takeaway from Buffett's perspective is that it's not about avoiding crashes, it's about being ready to take advantage of them. If you've done your homework and identified solid investments, a crash can be the perfect time to add to your portfolio. For small investors, adopting this mindset can be a huge difference. Start by building a watch list of high-quality stocks or funds you'd like to own. Focus on companies with strong financials, consistent dividends, or a track record of weathering downturns. For example, stocks like Apple and Microsoft or ETFs like VTI tend to recover well after market declines. Next, keep some cash ready. Not a huge amount, but enough to make strategic buys when opportunities arise. This doesn't mean hoarding all your money onto the sidelines. It means maintaining liquidity so you can act when prices dip. Most importantly, staying calm is critical. The market has always recovered from crashes, whether it was the Great Depression, the dot-com bubble, or the 2008 financial crisis. So it all boils down to this. For small investors, creating a balanced, diversified portfolio is the key to building wealth over time while managing risk. While the S&P 500 has been a reliable choice historically, today's market conditions call for a more nuanced approach. A strong starting point is to divide your investments across different asset classes. For example, you might allocate 60% of your portfolio to a total stock market ETF like VTI, 20% to an international ETF like VXUS, and 20% to bonds through an ETF like BND. This mix provides broad exposure to U.S. and international markets, along with the stability of fixed income investments. Even small amounts can grow significantly with time and consistency. If you start with $1,000 and invest $200 monthly into this portfolio, the growth potential is substantial. Over 10 years, this strategy could grow to approximately $37,000. In 20 years, the portfolio could reach $106,000, and in 30 years, it could surpass $240,000. These projections assume average annual returns of 8% for VTI, 6% for VXUS, and 4% for BND, returns that align with historical market performance. The magic of compounding means that every dollar you invest today works harder for you as time goes on. Before diving into investments, it's also crucial to establish an emergency fund with 3 to 6 months of living expenses into a high-yield savings account. This safety net ensures you won't need to sell investments at a loss if an unexpected expense arises. Think of it as a financial buffer that allows you to stay invested through market ups and downs. This way, you're set to ride the wave and also set to have caution if a hit comes through. No one can predict a crash, but if you want to know about a chart that has predicted every crash since financial markets began and is predicting the next crash, click the video on the screen.